Global stocks are celebrating the Fed's big rate cut as confirmation of a smooth, soft landing. The Bank of England holds rates as expected. The Bank of Japan is also seen holding later today. New Zealand's economy contracts less than the Reserve Bank forecast. And Australia's jobs market continues to give the RBA a headache. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Economist Henry Russell looks at the trip hazards of relying on high-frequency indicators, which the Reserve Bank of New Zealand may have just fallen over with second quarter GDP.
Manufacturing saw its largest bounce in several years. It was up 1.9% in the quarter, and look, that went completely against the signal from the PMI over Q2, which was one of the high-frequency indicators that the Reserve Bank took signal from.
But first in 5 and 5 with ANZ. Global stocks are up 2 to 3% as of 4 a.m. Sydney-Melbourne time, the day after the Fed's big rate cut to start its easing cycle. ANZ economist Bansi Madhavani says US jobless claims overnight were solid and reinforced investor hopes. The Fed has just pulled off the softest of soft landings.
The data did not indicate any layoff-led deterioration, and that supports our view that Fed is set to deliver a string of 25 basis point cuts unless labor market deteriorates materially. In terms of the market reaction, what we saw is that the 50 basis point cut has reinforced this soft landing narrative. As a result, equities were higher and trading at record high across the board.
Number 2. The Aussie and Kiwi dollars are up solidly this morning, with risk appetites definitely on after the Fed's cut undermined the US dollar. As of 4 a.m. Sydney-Melbourne time, the Aussie dollar is up 0.8% at 68.23 US cents, and the Kiwi dollar is up 0.7% at 62.50 US cents. Solid economic data in Australia and New Zealand yesterday has also helped. More on that later, but here's ANZ's head of FX research, Marja Ben-Zaman, on the reaction in currency and bond markets yesterday and last night.
A tight labour market clearly reduces the chances of a discussion around any rate cuts anytime soon. We've also seen 3-year yields on Australian bonds, government bonds, rise on this resilient employment data, which really points to the fact that the expectations around a rate cut in 2024 is reducing, and we continue to expect the RBA to begin easing in February 2025.
Number 3. New Zealand's economy contracted 0.2% in the June quarter. That was above the negative 0.4% consensus and the negative 0.5% number the Reserve Bank had forecast. ANZ economist Henry Russell says the data indicate that the high-frequency indicators the Reserve Bank relied on to downgrade its August forecasts may have overstated economic weakness.
Broadly, the data are consistent with a very, very weak economic momentum, and that's unlikely to change anytime soon. But it was stronger than what the Reserve Bank had been anticipating, and that's likely means that for now the Reserve Bank will stick to 25 basis point cuts at least over the next coming meetings across the rest of this year, and just wait and see how the economy does respond to lower interest rates as we're starting to see in the data, as is starting to emerge in the data.
Number 4. Australia's labour market continues to outperform. Unemployment held at 4.2% in August as jobs grew nearly 50,000. That was double expectations. ANZ senior economist Catherine Birch says the strength supports ANZ researchers' view that the RBA won't cut until February, with the risks pointing to an even later move.
There are still large numbers of people entering the labour force and actually finding work, and the proportion of people who are working fewer hours than usual due to economic reasons, so no work being available, that's still running below pre-pandemic levels, which suggests that there's still this ongoing tightness in the labour market. And this really aligns with the RBA's assessment that we heard last week from Assistant Governor and Chief Economist Sarah Hunter, when she said that the labour market is still operating above full employment.
Number 5. To finish off a big week for central banks, attention now turns to the Bank of Japan, which is partway through a tightening cycle. ANZ senior economist Tom Kenny says he's expecting the Bank of Japan to hold today at 0.25% after July's 15 basis point increase. Tom says the fact there has been no media leaks ahead of the meeting indicate not much will happen.
Any change in policy today would be too soon, given that the Bank of Japan hiked rates by 15 basis points at its last meeting. It also announced a reduction in its purchase of JGBs at that time. The Fed's decision to cut rates by 50 basis points also at the margin takes appetite off the bodge-altering policy today.
Tom Kenny there. Now, in our bonus deep dive interview, ANZ Economist Henry Russell spoke to my colleague Alex Tarrant about how New Zealand's second quarter GDP numbers show high frequency data can sometimes overstate underlying economic weakness or strength, and he talks about the implications that has for monetary policy.
Yeah, there were certainly some ups and downs. Some of the components are obviously more volatile than others, and the one that provides the best signal for momentum moving forward is services industry's GDP. That was actually a touch weaker than what we'd expected. It was flat in Q2 against our expectation for a very slight lift, but that was offset by a reasonable bounce in goods producing industries. And look, there is probably an element at play here, but within that, manufacturing saw its largest bounce in several years. It was up 1.9% in the quarter. And look, that went completely against the signal from the PMI over Q2, which was one of the high frequency indicators that the Reserve Bank took signal from and underpinned its decision to cut the OCR in August. So when we think about the outlook moving forward, we continue to expect that growth across the rest of this year will be anemic and a gradual recovery will follow through 2025.
Is this sort of a lesson in terms of the reliance on the high frequency data?
In some respects, yes. It's always good to be cautious about these data. They are incredibly volatile. And if you think back to what happened in August, there wasn't a clear catalyst for the sharp deterioration we saw across those indicators. And some of it probably reflects sentiment or the change in sentiment following the Reserve Bank's very hawkish May monetary policy statement, where they said that OCR cuts would not occur until August 2025. And that's probably weighed heavily on these data, which are informed by sentiment. And again, now that interest rates are falling, we are seeing those indicators bounce back, but they are probably overstating the extent of the recovery. Some, including our own Business Outlook survey, business confidence in that is at the highest level in 10 years. But that is very unlikely to translate into a material pickup in activity across the rest of this year.
And just finally, looking at those per capita numbers, I mean, could that be used as an argument that things are actually really weak?
It's no question that momentum is really weak and households are doing it really tough. But from the Reserve Bank's perspective, they don't have a growth target nor a per capita growth target for that matter. Their focus is on inflation. And what matters on that front is the imbalance between supply and demand. The Q2 data were absolutely consistent with ongoing disinflation progress. Thinking about it with respect to the supply side capacity of the economy, the Reserve Bank estimates the New Zealand economy can grow at a pace of 0.6% quarter on quarter without generating inflation pressures. Obviously, we're a long way below that and have been for some time, and that's now flowing through to disinflation, particularly across the domestic components that have been sticky. And so moving forward, yes, per capita GDP is very weak, but the Reserve Bank will be very cautious about the risks that inflation does not get all the way back to 2% should demand in the economy stabilise. Ultimately, what the Reserve Bank's decision is going to come down to is how they view the inflation outlook. GDP is a part of that, but it's not the focus.
Henry Russell there, speaking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, the 20th of September. Catch you next week with more analysis of what happens when the Fed starts easing. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.